First thing we're going to talk about is fundamental analysis when we're trying to select a stock for a option strategy. And fundamental analysis is a discipline where you study the earnings, the dividends, the cash flow of a company, and that's normally that's the standard way of evaluating a stock would be to examine its earnings growth or maybe its return on equity. But I found that the earnings growth is not always reliable or very predictive of a stock's performance because the earnings is subject to interpretation by accountants, and there's a lot of pressure nowadays to meet the earnings or beat the earnings, and it's not always a good indication of whether a company is really growing. Okay, so I came up with a better way to measure a company's growth. I call it the real growth indicator. And the real growth indicator, it measures the characteristics of a good business. Number one, companies with little or no long-term debt. Number two, companies with strong earnings and the ability to retain those earnings. And then the third would be companies that successfully reinvest their retained earnings. This pretty much follows the guidelines of Warren Buffett. He looks for companies that have these characteristics. And I worked in the airline industry for 20 years, and that's a good example of an industry that doesn't follow these guidelines because they very rarely retain their earnings because they always had heavy capital expenditures for purchasing airplanes, and they have a very high labor costs. So that would be an example of a company that doesn't retain their earnings and doesn't get a good investment on their retained earnings. Now, the way we measure the real growth indicator is we measure the book value growth. And the book value is calculated by subtracting the liabilities from the assets of a company. So if you can track the book value growth, then you're going to track all those favorable characteristics, and also will track the unfavorable characteristics. If a company takes on a lot of debt, that will show up in their book value growth. That'll reduce their book value growth. So I found it's the best way to identify real growth companies. If they're growing their book value, then they're growing the net worth of the company, and that's a company that you want to study further. And what I did is I took a couple examples of companies that had a healthy book value growth 5 years ago in 1995. And then I traced their progress over the last 5 years just to see what their overall return was. This is a chart of Cisco Corporation, not the tech stock, but the food distributor. And in 1995, they had a real growth rate in their book value of 15%. And then their 5-year return was 361%. So that's an example of a company with good book value growth and a good return over the last 5 years. Here's another example. This is Sears Roebuck. And in 1995, their real growth indicator was a minus 8%. So they've had a negative growth in their equity. And then their return over the last 5 years has actually been negative, a negative 15% return. So there's an example of a company that they probably had some one-time write-offs that occurred that reduced their stockholders' equity or their book value, or they may have taken on debt. In any case, they had a negative book value growth and actually a negative return over the last 5 years, and we've been in a tremendous bull market. So that's a good indication that if you had looked at the book value growth 5 years ago, you might have said, no, I don't think I'm going to invest in this company. The real growth indicator, that's one way we can tell if a company's healthy and it's really growing and if it's worthy of further study. And another indicator I've used over the years has been the Standard & Poor's ranking of a stock. They they rank stocks for their 10 years consistency of earnings and dividend growth. And they rank over 10,000 stocks. Only 81 of these stocks have an A+ rating. So if you see a stock that's got an A+ rating by Standard & Poor's, that's another company that you want to take a look at. And what we're trying to do here is we're trying to find good companies so we can implement the covered call strategy or a put selling strategy on the company. And those are strategies that we'll learn as we get further along here. And I have a list of all the Standard & Poor's A+ rated stocks in the manual there. Here's an example of some of them: Abbott Laboratories, Aflac Insurance, Alberto Culver, American International Group, Automatic Data Processing. So these are all companies that have had very consistent earnings and dividend growth. So these companies are worth taking a look at. And then another screen I use to find good, healthy companies is Moody's list of dividend achievers. And the dividend is really a good indication of a company's health, because they're not going to declare a dividend unless they have the money to pay it out. So if a company has a high dividend growth rate, you know that they're doing well. And this is a sample list of the dividend achievers. I have the full list in your manual. But in order to be a dividend achiever, the company has to raise its dividend for at least 10 years in a row, 10 consecutive years in a row. And you can see some of these companies, like Cisco Corp, the food distributor, they've increased their dividend 23 years in a row, and they have a 24% dividend growth rate. So that's an indication to me that that company's healthy, it's growing, they can afford to pay out dividends, and they're increasing their dividends on a regular basis. A good sign.